Two best dividend stocks to buy right now in the stock market. This is what this video is about. I personally call them easy money stocks. I think overall in general, most dividend stocks right now are easy money over the next 2, 3, 4 years. We have high interest rates. People don't want to own them. So these stocks have been selling off. Most of them are paying above a 6% dividend. So you're getting paid a 6% plus dividend while you wait for you to make even more money from price appreciation and a multiple expansion, and earnings will likely be growing in this period. So in terms of a risk reward setup, in my opinion, you could lose money on any stock, of course, but it's hard to lose money with those stocks over the next few years. But on the contrary, the upside is pretty good. I mean, double-digit kind of upside. This is what I see with those two stocks. Very large companies, very good companies. I'm going to discuss them, and I really hope you enjoy the video. If you do, please press the like button and let me know what you think in the comment. Now, the first stock, which is a popular one I talked about before, I talked about both of them, but these are, in my opinion, the two best risk-reward setups. Not much risk, but they have some decent reward. The first one is VC Properties. It's now trading at $28.77. It's down 12% year to date, sitting pretty close to its 52 weeks low. Most of you are familiar with VC Properties. They have many properties in the United States, but especially in Las Vegas, on the Las Vegas Strip. They have a lot of, you could call trophy properties that it's just amazing stuff, amazing moat. They have just amazing properties, Luxor, Caesar, and so many different things. It's just amazing company, and they have a high moat in terms of Las Vegas, in terms of these properties. I mean, it's pretty amazing stuff, really. Just absolutely stunning. And the best part about VCs, the reason it's safe, is because they have very long-term leases. For Caesars, for example, the weighted average lease term is 31 years. For MGM, it's 51 years. The Venetian is 47 years. Hard Rock Seminole, 53 years. So these leases are just very long, 30 to 50 years. And they will likely be renewed even after 50 years. These properties are not going anywhere. So you don't have much problem with vacancies and occupancy and all these kind of things. It's just amazing business model, and it's a very safe company. Now, the problem is with those long-term leases, you have the CPI, you have inflation, of course. Not all of them are indexed to the CPI. Right now, 50% of them are indexed to the CPI, meaning if the CPI is 5%, they could increase rents 5%. But they're working on it more in the future. And as those leases expire, they're going to be more covered under the CPI. And they expect by 2035, which is like 11 years from now, 96% of them will ultimately be covered under the CPI, which is something very good. The company has been a very fast dividend grower, 7.9% growth, pretty amazing stuff for the dividend. In terms of the balance sheet is also very safe for the company. 99% is fixed. Most of the near-term maturities they can handle it very easily, in my opinion. Most of the debt is not due before 2032, the major ones. Before that, there's not much going on. They can easily manage the debt. So that's pretty good for the company. Now, if you look at all these things, the companies that don't have a lot of debt, the debt is manageable. They have very long-term leases, 30 to 50 years. A lot of them are indexed to the CPI. It's all amazing. But the main problem with VC is that because it's so safe, it's really priced accordingly. So you're not getting much of a multiple expansion. With REITs, you normally get returns in three ways. You get a multiple expansion when interest rates come down. You get the dividend yield, of course. You get it every single year, or they pay it quarterly or monthly for dividend yield. The third thing you get is adjusted funds from operation per share growth. This is just like earnings per share. So you get normally earnings per share growth, you get the dividend, and you get a potential for a multiple expansion. For VC, you have two of them, but you do not have the potential for a multiple expansion. The current multiple is 12.6 times AFFO. The mean was 14 times. It's not like Realty Income or other companies that are trading well below the mean, and interest rates come down, you can get a multiple expansion. The main reason VC is not going to likely experience a multiple expansion is because the company is extremely safe. Because it's extremely safe, it's not going to be trading at a very cheap multiple. The market knows it's safe. It knows that these leases are 30 to 50 years with just amazing high-quality tenants that aren't going anywhere. So this is the main thing with VC. It's extremely safe. It has low downside, but you're going to have to give up some upside in terms of a multiple expansion. So I'm not going to be counting a multiple expansion in this analysis. You have the dividend. It's pretty close to a 6% dividend. That's a very good dividend to get paid while you wait. in terms of AFFO per share growth, adjusted from operation per share growth. I mean, before COVID, it was like 10, 11%. Even in 2023, it was 11%. But going forward, based on the guidance, is expected to be around 4 to 5%. So if we just count 4% on AFFO per share growth, and you have the 6% dividend, this is a 10% annual return just for holding VC. And if VC does grow again, it grows, let's say, 8% instead of 4%, then you have more upside beyond the 10%. If VC goes a little bit lower, you buy the dip a little bit more, and it experiences a multiple expansion later on. This is even above a 10% return. So for me, looking at VC, worst case scenario, I'm getting 10% if I want to buy the stock today and hold for a few years and see what happens. It's much better than putting it in my broker, getting 5%. If I'm looking for 10, 12%, low risk, pretty decent reward kind of stock, I think VC is a perfect stock. 10% on the low end, high end maybe 13, 14%. So it's not much upside, but the risk is extremely limited, in my opinion, from the nature of the business model. Pretty amazing stuff, high quality company. I really like it over here. And again, 10% a year is really not bad with a company like VC. The second one has much more upside than 10% a year. And it might not be for everyone, because I know a lot of you have certain things where you don't invest into such companies, and it's fine. It's not for everyone. But this company is called BTI. I talked about it many times, and it's still trading in the same range. It goes up to 32, 33. It goes down to 28. It's been the same thing since December of 2023. It's a very tradable stock. I told you guys about this. Maybe a lot of the technical analysts can agree with me. I normally, whenever I used to own BTI, I used to hold it for the dividend, and I sell the $33 covered calls. It never gets above 33, and I collect an extra 4 to 5% yield every single year on top of the dividend. And I was making like 15% a year just holding BTI. And I share more of that stuff in my own group if you're interested. I have videos on covered calls and put options and all these kind of things. But for BTI, it's still trading in the same range it was before. If you're not familiar with the company, most of you are, but if you're not, they have a lot of old school combustibles, you could say Newport and Camel and Lucky Strike, and a lot of old school stuff, American Spirit. But they also have a lot of the new stuff, a lot of the vapor and all these things, especially Views. They have Velo also, but Views is extremely popular for vapor for the company. I mean, it's really popular. It's number one, number two in many countries across the world. And I believe it's the leader in the United States right now. So this is an amazing brand for the company. And the best part about it is I believe BTI did not acquire these companies. So it's not like Altria overpaid for Juul and now it's worth I think 50 million or something, and they paid crazy amounts. No, British American Tobacco, I believe they started it in-house and they grew these brands. So it was much more efficient than companies like Altria. And if you look at this category, it has been rapidly growing. I mean, it was growing 30 to 35% annual for that stuff. And in 2023, it's finally turned profitable for the first time ever. And it's eventually going to be bringing in even more free cash flow to offset the decline from the old school traditional combustible or consumable cigarettes. So BTI is not just sleeping and then the industry is declining and the stock is not doing anything or the company is not doing anything. They're working on, going into new areas and different things to offset the decline. And BTI does not need to grow. If it just can offset the decline, that's more than enough based on the current valuation that BTI is trading at. And I showed you all these things for BTI. And if you look at where the company is trading at, it's trading at a 15% free cash flow yield. Now, immediately, whenever you see 15% free cash flow yield, you're most likely saying the company is most likely in decline. It means it's declining in revenue. So it's declining 10, 15% a year in revenues. Therefore, this must be a trap. The 15% is too good to be true. It's impossible. You look at the dividend. The dividend is 9.5%. You look at a 9.5% dividend, you might be saying there's no way BTI can sustain the dividend. Maybe the payout ratio is high and just dividend is going to be cut. But both of those assumptions are wrong. The company is still growing. They grew 4% earnings per share. In terms of revenue growth, they increased 3.1%. It's not a company in declining, even though it's trading at a 15% free cash flow yield. And it's yielding pretty close to a 10% dividend it was. The company is still growing. Yes, if you look at the mix, for example, volumes, because people are smoking less old school stuff, it did decline. It declined 5.5%. But because they have pricing power, they increased prices 6.1%. And you have the new category, which is the vapor and Views and Velo and these categories I showed you, they grew 21%. Yeah, I mean, that's pretty amazing for a company yielding 9.5% and a 15% free cash flow yield. So the company is not in decline. The second assumption is maybe the dividend will be cut. At 9.5%, it's not sustainable. It has to be a trap. And I've been saying it for a while. I do not believe that this dividend will be cut, and I don't think it's a trap. The company pays around $5.1 billion every single year in dividends. This is what they paid in 2023, 5.1 billion. If you look at the free cash flow, it was 10.2 billion. It's expected to be 8.1 billion going forward. I believe this is pricing in a decline in the United States because they were trying to ban menthol cigarettes in the United States. I think they avoided it for this year, but it might come in maybe in 2025. But it was supposed to be banned like a year ago, and they keep pushing it. So I'm not sure if it's going to happen or not, or what's going to happen with this ban. But BTI does have a lot of exposure to this area, and I believe this is one of the reasons why the analysts are expecting 8.1 billion instead of 10.2 billion. But even with 8.1 billion of free cash flow, the dividend is 5.1 billion. That would leave them with over $3 billion in extra free cash flow to pay down the debt or even do buybacks, which they actually been doing buybacks recently. They stopped before, but they started doing them again. And that's pretty good stuff. So the dividend is very well covered. The last thing you might believe is that this company has a lot of debt, and that's why it's cheap. And again, you're 100% right. The company does have a lot of debt. If you count all the debt, the long-term debt, current portion of the long-term debt, and the deferred tax liability, which is 15 billion, is also debt. If you count it in total, this is pretty close to $65 billion, US dollars. So $65 billion of debt for this company. That's really a lot of debt. But the company does have some free cash flow, and it has some things they've been using recently. And this is a stake in an Indian conglomerate, which I believe has a lot of, it's a cigarette maker in India, I believe. And they started selling some shares. They sold a little bit of shares, amounted to $2 billion, and they used this money to do buybacks and pay down some debt. Now the company has been selling their stake, and they still own 25.5% of the company. Now this company, in terms of US dollars, is worth $61 billion. 25.5% of it is $15.8 billion. So the company can raise an extra $15.8 billion if they want to sell their stake in this company and use the $15.8 billion to pay down some of the debt. So I don't believe the company is going bankrupt because they cannot pay the debt. I mean, they have a strong free cash flow profile. They could refinance if they wanted to. If they had to have some money, they could sell some of the stake. It's worth a lot of money and pay down the short-term obligations and do a lot of things. So I don't believe the debt is as bad as you believe it is with BTI. I think it's very manageable in the short term. So for me, BTI, I mean, the way I look at it, you need a lot of patience because the company has just been trading in this range for a while. It keeps getting cheaper. People call it a value trap. They love to hit on the stock. But I mean, if you want a 9.5% dividend, the dividend is sustainable. And you have a lot of potential for a potential multiple expansion. But if you're not looking for that stuff and you want the 9.5 to 10% dividend, you could sell the covered calls, $33 covered calls. I made the calculations. If you sell January 2025, $33 calls on your 100 shares plus, you would get around a 4.5% annual return. 4.5%, you have the 9.5% dividend. This is around a 13% annual return for holding BTI. So the way I look at it, BTI is again low risk. I don't see much downside from here. I mean, it's valued at ridiculous valuations. The dividend is safe. The upside from here is unlimited, but we don't know when it's going to happen. Of course, the main risk is government. They could do a lot of things. They could ban certain vapes. They could do certain things. We cannot predict it. But I think the stock is undervalued, and I think VC is undervalued. And that's my two stocks for the month in terms of dividends. Thank you for watching the video. Not financial advice. I really hope you enjoyed it. If you did, please press the like button and maybe consider subscribing. So I hope to see you in another